In 1942, an 11-year-old boy spent every cent he had saved, $114.75, on 3 shares of stock. Weeks later, it crashed 29%. He panicked. He sold for a $5 profit just to make the fear stop. Then it went to $202 a share. That mistake made him so angry at himself, it became the seed of a $140 billion fortune. By the time he was done, he'd be worth more than the GDP of most countries on Earth, and he'd still be living in the same 5-bedroom house he bought for $31,500. We'll get to that house. Hang on to it. In 1999, they put him on a magazine cover and asked in print if he'd completely lost it. And somewhere in 80 years of never breaking his own most famous rule, he broke it exactly once. Omaha, Nebraska. Warren Buffett was 6 years old when he bought a 6-pack of Coke for 25 cents and sold each bottle for a nickel. Small math, but he never stopped doing it. He was 14 when he filed his first tax return. He deducted his bicycle and his wristwatch as business expenses for his newspaper route. A child already finding tax loopholes. A year later, at 15, he was running a chain of pinball machines inside barbershops across town under a fake company name so no one would guess a teenager owned them. But before any of that, before the pinball machines, before the tax forms, there was a library book that started it all. He was 11. He found a book at the library called 1,000 Ways to Make $1,000. Somewhere in those pages, something clicked. Money could make more money without him doing anything at all. He begged his father, a stockbroker, to let him buy in. And in March of 1942, he did. 3 shares of City Service Preferred at $38.25 each. He brought his older sister Doris in as a partner, spending both their savings. Then the market dropped. The stock fell to $27. Every single day, Doris reminded him. So the moment it crawled back up, the second he could sell for a small profit, he did. Relief. Problem solved. City Service Preferred went on to hit $202 a share. Buffett had walked away from nearly 5 times his money to save himself a few weeks of discomfort. He would later call it one of the most important lessons of his life. Not because he lost money, because he learned that fear is expensive. He was 11 years old and he had just learned a lesson he wouldn't know how to actually use for another decade. That would take a professor in New York. At Columbia Business School, Buffett found the book that would rewire how he saw money. The Intelligent Investor by a professor named Benjamin Graham. Graham's whole philosophy could fit on a napkin. Imagine walking down the street and spotting a discarded cigar butt on the ground. Ugly, unwanted. Nobody else would touch it, but it still had one good puff left in it, and that puff is free. That's what Graham taught him to look for. Beaten down, unloved companies trading for less than the cash sitting in their own bank accounts. Not exciting, just cheap enough that even one good puff made it worth the trip. Price is what you pay. Value is what you get. Buffett took the lesson and ran with it, buying broken, forgotten little companies for pennies, squeezing out that last free puff. Moving on to the next one. For years it worked. Cigar butt investing built him his first real fortune, but cigar butts run out, and you can only smoke so many free puffs before you're standing in a very large, very smelly pile of garbage. It took one man to convince him he was thinking about the whole game wrong. Charlie Munger didn't want cheap. He wanted good. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It flipped everything. Instead of hunting for one last free puff, Buffett started hunting for companies so good he'd want to own them forever. And that same year, he made a different kind of purchase, one that would never change for the rest of his life. A 5-bedroom house on a quiet Omaha street. $31,500. Remember that number. He would still be living in it, unchanged 68 years later, while everything else around him turned into something almost nobody could count, which makes it darkly funny that the company whose name he'd use for the rest of his career, Berkshire Hathaway, was neither cheap nor wonderful. It was a dying textile mill. Buffett only bought total control of it after the owner tried to lowball him in a stock deal by 1/8 of a point. Fine, I'll buy the whole company. Out of spite, he bought a dying business. It would take him years to admit that decision cost him billions, but by accident, it gave him a shell he could pour money into. Buffett started buying insurance companies inside Berkshire. Insurance companies have a strange superpower. People pay premiums today for a claim that might not get paid out for years. In the meantime, that money just sits there. It's called float. Free money. Borrowed from strangers who don't even know they're lending it. Buffett took that float and invested it into wonderful companies. Coca-Cola, American Express, Gillette, and let something else do the rest of the work. Compound interest doesn't announce itself. It just sits in the corner of every decade of this story, quietly turning $1 into $2, $2 into $4, $4 into 16, while the rest of the house that started it all never adds a single room. By the time anyone else noticed how big it had gotten, it was too late to catch up. Then came the year the whole machine got called a relic. By 1999, the whole country had a new religion: internet stocks. Companies with no profits, sometimes no product, were worth more than entire industries. And Warren Buffett wouldn't touch a single one of them. I don't invest in things I don't understand. Berkshire Hathaway stock sat still while dot-com stocks doubled in a month. Investors who made fortunes following him started selling. A major financial magazine ran a cover asking flatly, "What's wrong, Warren?" For one stretch that year, a single company called Yahoo, a search engine 3 years old, still losing money, was worth more on paper than the entire company Buffett had spent 40 years building. Investors quit annual shareholder meetings early to go day trade tech stocks in the parking lot. People openly called him finished. Behind closed doors, even Buffett admitted it stung. He didn't change a thing. He didn't buy a single dot-com stock, not one, all the way through the mania. Then, in the spring of 2000, it broke. Trillions of dollars vanished in months. Companies worth billions on paper were worth zero. And Berkshire Hathaway, boring old-fashioned left-behind Berkshire Hathaway, quietly climbed while almost everything else around it turned to ash. The magazine never ran a follow-up cover admitting they were wrong. They didn't have to. The stock price said it for them. 2008, banks that had stood for 100 years collapsed in weeks. Trillions evaporated. Everyone with money was trying to get out. Buffett bought. Be fearful when others are greedy, and greedy when others are fearful. He poured billions into Goldman Sachs and General Electric while the rest of the country was selling in a blind panic. It wasn't bravery. It was the same arithmetic that an 11-year-old learned the hard way 66 years earlier, which makes it even stranger that the man who could buy almost anything on earth still lived in that same house he bought in 1958. Same address, same 5 bedrooms. He drove himself to McDonald's and paid with a card that had Berkshire Hathaway on the top and a coupon in his other hand. In 2006, he did something almost nobody at his level ever does. He pledged to give away the overwhelming majority of his fortune, not after he died, but starting immediately, mostly to the Gates Foundation. The man who once refused to let go of a $5 profit spent the second half of his life learning to let go of billions. Late last year, he finally stepped away from running Berkshire day to day after roughly 6 decades at the wheel. And somewhere in all 80 of those years, he broke his own rule exactly once. Not in a stock, with a house. He let himself keep the one thing that never had to grow. Here's the part that actually matters for you tonight. Not a lesson, a number. Imagine 2 people. Both invest $100 a month into an ordinary index fund, earning an average 8% a year. One starts at 20. The other waits 10 years and starts at 30. By 65, the person who started at 20 ends up with roughly double the money the person who started at 30, even though they only put in about $40,000 more total. That gap isn't from working harder. It isn't from picking better stocks. It's from 10 extra years of letting compound interest do its work undisturbed. So here's the number that matters more than any stock tip you'll ever hear. The year you start. 3 things you can actually do with that starting tonight. 1, automate it. Set an amount, any amount, to move into an index fund every month before you can spend it. 2, write down before you invest a single dollar exactly what would make you sell and nothing else. That's the rule Buffett broke at 11 and spent 80 years making up for it. 3, when the market crashes, and it will, don't open the app. Buffett didn't get rich by watching the screen. He got rich by refusing to touch it. Buffett put the whole philosophy in one line. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He didn't get rich by being brilliant. He got rich by refusing to move.